Hello, I'm Rachel Jones for the Finance News Network. Joining me today from Windlab is Executive Chairman and CEO Roger Price. Roger, welcome back to FNN.
Hi Rachel, it's great to be here.
Now, Windlab is a wind farm developer and operator with projects in Australia and internationally. Can you tell us more?
So Windlab uses world-leading atmospheric modelling and wind energy prediction tools to identify wind resources around the world. We've done that now successfully in parts of North America, Australia and Southern Africa to build a big development pipeline of over 50 projects, 7,500 megawatts of potential capacity. Importantly, about 1,500 of that already has a development approval and once financed is ready to build. About half of it is in Australia, and that includes exciting projects like Kennedy Energy Park, an industry-first wind, solar and battery storage hybrid nearing completion in far north Queensland.
And Roger, now before we get to your results, your industry always seems to be in the news and at the front of political discourse. What can you tell me about that?
Well, that is a very interesting topic. It seems that successive federal governments have been unable to reach any sort of bipartisan agreement and implement long-term stable energy policy. With the lack of that policy, it does impact investor sentiment and confidence. We find that leads to delayed investment decisions, tighter supply and ultimately higher prices. Now that's not good for energy users and no one thinks it is. And it most probably means some short-term perturbations for the renewable energy industry in Australia. But importantly, over the medium term, we actually don't think it'll make that much difference. And that's simply because of market dynamics. Wind and solar are now the cheapest forms of generating technology you can build. And in Australia, over the course of the next 10 years or so, we will turn off about a third of our coal-fired generators, some 9 gigawatts of capacity, because they're simply too old. They'll be over 50 years of age, they're inefficient, they're expensive to operate, they're dirty. That capacity will be replaced by wind and solar, and we'll see that occur purely because of market dynamics.
Thanks, Roger. Now to your first half 2018 results. What were the highlights?
Well, I think in a nutshell, things have gone as planned. We operate on a calendar year end, so June was our half year results. The revenue for the first half was modest, but that's as planned, where most of our revenue this year will come from the financing of a large project called Lakeland in far north Queensland, a 100 megawatt wind farm. That's scheduled for the second half of the year, and with that we'll see most of the revenue delivered in the second half of the year. But even in the first half there are some good financial highlights. Perhaps the most important one is we've seen a 40% year-on-year growth in recurring revenue between asset management fees and distributions from operating wind farms.
Excellent. And now to your strategy and share price. What can you tell me about the company's strategy?
Well, that's pretty easy really. We're just looking to do more of the same. We've used our technology to identify the best wind resources in the markets that we operate. We've built out over the last few years a capability in the organisation to do everything from greenfield identification, development, approval, financing, construction and now asset management. We've completed projects like Canoa Bridge Wind Farm and Kayata in Victoria, which are now the best performing wind farms in Australia by capacity factor. We've got 50 more projects to do in our pipeline. So really, all we're seeking to do is do more of the same. 1 or 2 projects a year, and by doing that, we will grow value for the company and for shareholders.
And could you provide a comment for us on the share price over the last 12 months?
Yeah, we're a little bit frustrated by the share price. We don't think it reflects the true value of the company, nor the performance of the company since we IPO'd the business in August last year. I think there's most probably 3 reasons for that. I mentioned before the political discourse, the uncertainty at a political level playing on investor sentiment. So I think that's got to have some impact on our share price. We had a number of long-term shareholders in the business who supported the company when it was a private company, investing 10, even 15 years ago, and with the IPO, some of them have sought to sell their position, which has put some downward pressure on the share price. I also think it's fair to say that with very, very few comparables on the ASX, the market is still coming to grips with both the sector and Windlab's business model. All of that said though, the business is delivering. We're meeting the milestones we said we'd deliver. We're focused on operating the business, and we feel if we continue to deliver, the share price will take care of itself.
And last question now, Roger. What is the outlook for the company and why should investors consider adding Windlab to their portfolios?
Well, what I think investors should look for over the course of the next couple of months is the Lakeland Wind Farm reaching financial close. That will deliver a significant revenue event for the company and should top off a successful year for the business. At a larger scale though, renewable energy is now an enormous global business. Over $400 billion a year are invested internationally, and Windlab has a number of great opportunities. Yet Australian investors have very limited exposure to this sector. There are very, very few established, profitable businesses on the ASX that investors can invest in. Windlab provides one of those rare opportunities. We have a successful track record of both growth and profitability, and I think it's fair to say at our current share price, we most probably represent great value.
Roger Price, thanks for the update.
Thanks, Rachel.